Structured notes basics. What is a structured note? Well, is a deposit or a loan made to a major bank. The bank issues contract, have predefined rules, and determine how returns are earned based on the performing of an underlying asset. Also on the bank's credit at maturity. That notes are issued in increments of $1,000. So these are not products solely for the uber wealthy. The goal of structured notes is to replace existing exposures in your portfolio that have a defined return. They're going to reduce the volatility of your portfolio through protection. So if the market sells off, so you don't lose money. They also enhance investment performance by using participation multipliers or absolute returns that will overperform the market. They can also generate high-yielding income. They can be customized. We've customized several structured notes here at Triathlon Partners. There's a lot of defined terms and jargon that is associated with structured notes. There's an initial level or initial date, final level, final date. Now, maturity is the date or the length of time when the note ends. Notes have something called protection. There are different types of protection. Sometimes the protection is called a barrier, and sometimes it's called a buffer. Those are two different things. We also have principal protection either by the issuer or that's FDIC insured, that's government insured, just like a CD. I mentioned that notes have this participation multiplier, which determines the value of the note when it matures. And a different type of participation is called absolute, which is back to algebra in 7th grade, which if the market or underlying asset is negative, the participation in the return of the note can be positive. A step-in, which guarantees a minimum rate of return. There are some caps or limits on maximum gains, or something called a worst or least performer, because some structured notes are based on the performance of 2 or 3 or 4 different underlying securities, but the final valuation is based on the least or the lowest performing asset in that group. A term called rainbow, and we're going to have a great example of that later on. Observation dates, those are dates when something can occur. Callable, you have auto callable note, which means if certain market conditions are met, it's called, or if the issuer gets to decide on those observation dates. And these notes usually have a window when they cannot be called. We're going to talk about protection and participation. Protection, there are 3 types. There are buffers, barriers, and principal protected notes, which are 100% guaranteed. Either issuer guaranteed, which is subject to the credit of the issuing bank, or FDIC insured, which is backed by the government. Now, a buffer is permanent protection by absorbing an initial loss up to a certain percentage. If we would use the term a 20% buffer, that would cover the first 20% loss. If the asset that the structured note is based on is down 15% at maturity and has a 20% buffer, you would get 100% of your principal back. Underlying asset was down 25%, you would lose the difference between 20 and 25, so down 5%. This is in contrast to a barrier. A barrier protection is contingent. A 30% barrier, all losses up to 30% would be covered by the note. So if you were down 25% on the underlying with a 30% barrier, you get 100% of your principal back. A 30% barrier, but a 35% loss in the underlier, you would actually lose 35% of your money. That is why I call it contingent. A graph shows the principal protected note, which is the green line, and we can see it never falls below 0. The buffer, we can see once the underlying asset's down 20%, then you start losing money. The barrier note, once you hit that 30%, you start losing as if you were short the asset on its own. A 50% loss is a 50% loss in the barrier note. The buffer note would be a 30% loss, and the principal protected would be 0 loss. The note's return is calculated as a multiple of the market's return. We have an absolute return, which we explained. If the market is negative, You can get a positive return based on the market performance. The step-in, which has a minimum gain under predefined circumstances, usually if the market is, or the underlying asset is positive at maturity, you get that stepped-in rate. And we have caps where there's a maximum amount that you can earn. And I have another graph. I'd like to start off with the participation multiplier. All these notes have that 30% barrier protection, right? So the green line has a participation multiplier where you could see the note actually outperforms everything else because the multiplier is 150%, right? As opposed to 100% for if you were long the underlying index, right? Then we can go to the absolute return, which its participation multiplier is just 100%, but it's absolute, meaning that you'll get positive returns if the underlying index is negative. Now, it is subject to that barrier. So once we hit that barrier, the gains all disappear and you start losing money, but you can see you get gains on both sides that are equivalent. And to also introduce the cap function, we have the blue line where in return for the cap, you also get a 200% multiplier. So that's why the capped line is higher when we're below that cap level of 30%. It's above the green and the blue, but then it also straightens out as does with the absolute return note. The maturity is usually between 1 and 5 years, and the maturity is how long the note lasts, like a bond. Now, typically, the longer the maturity, the more favorable the protection and participation is on the note. There are some notes that can mature early, and we briefly touched on that, and that's because these notes are callable. Now, when they're callable and the note no longer exists and your principal and your profits are paid out to you. Now, there are two different types of callable notes. One is auto callable. The other is called issue callable, meaning the issuer decides on the observation date, a predetermined time, if they want to call the note. But all of these notes have a non-callable period. Why these terms are so attractive in structured notes and what the trade-offs are of investing in a structured note versus investing in the underlying asset that note is based on. Now, there are two types of notes. There are growth notes, which combine a buffer or barrier protection with participation multipliers, and they're linked to one or more market indexes. Or we also have income notes, which also pair some protection to a high interest rate. Income notes are often callable. Now, how can these terms be so attractive? Which limits your losses, participation, which increases your gains, high coupon rates, and why will the issuers actually give such favorable terms? Well, the note is lending someone money, right? And when we buy the note, we give them the principal, we give them the investment now, and then the issuer doesn't repay that until maturity, and they invest it in the predefined payoffs that we're going to be getting in terms of that participation ratio or protection. Some of the things they use to hedge or to produce the returns that they need so that the notes, so we're able to make money on the notes, they don't actually pay for now. They pay for in the future as well. So they're able to take advantage of that. So some of those are futures, forwards, swaps. Times the issuer is going to buy the underlying asset that the note is based on, and those assets could pay interest or dividends. Now, options create leverage. Is a worst of structure. So that means of 2 or 3 selected assets or indexes, you don't know until the note matures which one your payout is based on. But the issuer has to hedge all 3. 2 out of the 3 are going to be better than the worst, and they'll make money on those. They are able to take those extra gains and put them into a participation multiplier or the protection on the downside. Mentioned before that options play a big part in these structured notes. They can take advantage of high volatility to give us great terms, as well as low volatility to give us great returns. These must have a high fee or commission. They are issued in increments of $1,000, and that's the minimum purchase you can buy. And the majority of notes are purchased on the issue date. Right now, there are two different distinct distribution channels. There's through a registered investment advisor, such as Triathlon Partners, or you can buy them from a traditional broker-dealer. Now, broker-dealers charge a commission. They vary between 2 and 5% of the note, as opposed to the registered investment advisor, who doesn't take a commission out of the note. There's a small fee for the firm that distributes the note of 0.25 or 0.25%. We're buying protection. We're buying a lot of great things when we put our premium down for the note. So if one note is going to have a 5% commission and one note is going to have virtually no commission, that means there's more money with the low commission to be buying those things we want. The participation ratios, the protection levels are far superior in RIA notes than in broker notes, so that your money is working for you. Now, the final point I want to make is the structured notes versus underlying securities. What are the risks of each one versus the other? Because that's going to determine if these investments are right for you. Credit risk, structured note, is the credit risk of the issuer versus underlying security is the credit risk of the securities. If you're looking to get dividends on a growth note, you're not going to get that in a structured note, but you get that in the underlying security. There are caps that limit upside on structured notes. Not all structured notes have caps, but there are no caps in the underlying security. Structured notes do have protection that can limit downside. Underlying securities do not. Now, structured notes are not very liquid as opposed to the underlying securities. In fact, you're going to be investing in structured note. That's money that you should be very comfortable investing for the maturity, the total maturity of the note, because if you don't, you're not optimizing that investment. So money you think you're going to need in 3 years, it is not appropriate to invest in a structured note that's 5 years long. Right? There's no holding period or no liquidity issues or no valuation issues in the underlying securities. Structured notes can be callable, and when something is callable, you have reinvestment risk, and you don't have that in an underlying security. I want to be very clear, the key risks and concerns: credit risk, contingent protection, not the buffer, not the principal protected. You have callable and reinvestment risk. You have liquidity issues. Things should be held to a maturity. No dividends. The caps can limit gains. In this exercise, we're going to compare a couple of notes that are very similar. Right? Part of the similarity is, number one, we're going to have to compare a note that's on the SPX, which is the S&P 500, versus the S&P 500 Futures Excess Return Index. So we're just going to call that the S&P, the Futures Index. The Futures Index doesn't take into account dividends, and because it's a future, current interest rates make a big difference. I have 3 notes I want to compare. Right? They all have maturity of 5 years. One's going to be on the S&P 500, and 2 are going to be on the Futures Index. One of the Futures Index is going to be principal protected 100% and guaranteed by the FDIC. The thing that differs between all 3 notes are the participation multiplier. Now, the participation multiplier on the S&P 500 note is 1.045. The Futures Index, that's not principal protected, has a multiplier of 1.9925, which is almost 2. And the principal protected note, where 100% principal is guaranteed, your multiplier is going to be 1.18. Right? So we have vast differences: 105, 1.2, and 2.0 is your multipliers. We have some protections that are different, but also the underlying index is different. See, we have a 5-year and a 10-year performance of the S&P 500 and the S&P 500 futures excess return index table, you can actually see that the S&P 500 over 1 year, and this is for the year of 2024, has overperformed by 6%, and for 10 years, 12. But overall, of a 5-year period, 10-year period, not so much a huge difference in terms of, well, we really want to own the S&P 500, but you got to remember, we're talking about owning them in a note and not owning them as individual indexes, right? And something to keep in mind is, well, I've been talking about lowering your volatility and the risk associated with the notes. Well, here's something that quantifies it. These numbers are the volatility, the annualized volatility of the excess return index and the S&P 500 differ by 0.1. And if the S&P 500 numbers are better returns than the index, futures index, and they have the same volatility, well, you would think, well, let's buy the S&P 500. Again, we're not buying the underlying index. We're buying them in notes, and we saw the terms of the notes. Here's an illustration of not just the 3 notes. We decided to just hold the index as well and earn the dividend on the index. Now, we know the index currently pays 1.8%. Pay that every year. We can see the orange line is the S&P 500 plus the dividends. Right? And we have this FDIC insured note. We can see that really you don't lose money. I'm also going to point out this green line, the note on the futures, because the participation multiplier is high. So that's the steeper one. And we know it's going to be a drop off like this because of the barrier. Note on the S&P 500. You still have that barrier protection, which, some people might say that's better than owning it outright. And you get a multiplier at 1.05. And you can actually see on the top side, it really struggles to beat the cash position, which earns the dividends. Historically, how have they performed? Why don't I take samples of every month for 5 years? So the average historical return of the S&P excess return index returned just under 75%, whereas the S&P 500 with the dividends was almost 82%, which is consistent with what we saw on the tables that the Insperix provided. Now, when we take the historical return of the note, we could see what we got to multiply it. This one by almost 2, and the FDIC note almost by 1.2. And how does that compare to the owning the cash with the dividends? Well, that's not a note. You're just earning just under 82%. So we could say almost 150%, almost 82%, almost 88%, right? And when we look at all those time periods, 100% of the time, the excess return note was the best one. And 2/3 of the time, the FDIC insured note did best, as opposed to just owning the one with the dividend. A good example of comparing the different variations of the underlying asset and showing how the note actually makes it more attractive. I'd like to introduce you to some more case studies on international equities, and I want to introduce an income note. Case study on international exposure, Vanguard, very well known asset managers, allocation guidance of greater than 20% to international exposure. So, okay, let's see if we can use a note to get better returns than just buying the ETFs or the indexes in our portfolio. That is a worst of note, and it's based on 2 international indexes. One's on the Euro Stock 50, only covers countries that use the euro, so Switzerland and the UK aren't involved. Morgan Stanley index, G10 developed countries, not US and Canada. 5-year maturity for this note. It's based on the worst performer. Again, we don't know what the worst performer is going to be. It's going to be one out of the 2. And we have the barrier of 30%. And we have participation multiplier of 2.2. Orange line is the worst of note. You can see the note performs quite well in a positive standpoint. You got that protection, and then that sell-off if you bust through that protection at 30%. Let's think, if I have a worst of 2 different assets, take my money and buy 50% into each one. So this table below assumes the average return on taking 50% into each of the indexes was 10.7. But the structured note had a 28.8% return. The multiplier on this note was 2.2 of the worst. Now, the average has the worst and the best. How is it then that the average times 2.2 is still less than the return of the structured note? The average times the multiplier should be higher than the structured note return, but it's not. Why? Because we have the protection on the structured note, but you would get a negative return on the average. When we looked at it over time, 78% of the time, almost 80%, the structured note was the better investment versus 22% or 20%, substantial difference in the return over the 5 years. Income notes, this particular one is based on a worst of 3 different asset classes, which you already have in your portfolio: the NASDAQ, the Russell 2000, the S&P 500. The term, the maturity is 2 years and 6 months. It's not callable for 6 months. 8.75 annual interest. It's going to pay you monthly, as long as the worst one is greater than 70% of its initial value. This will also be auto-called. The worst one is greater than 100%. You get all your principal back and the note is over. You also get that month's coupon. Current US Treasury rates are around 3.75%. So you're actually earning a substantial premium. How to incorporate structured notes into your portfolio, show you a customized note that we've written for our clients, how to customize a note for someone's specific situation. Better terms than the version that you are owning. They have protection, they have participation, and that's in exchange for dividends, liquidity, which if you're a long-term investor, it shouldn't be a concern. Now, they're great fixed income alternatives, but also you have to keep in mind that these protections lower the volatility of the performance of the notes. So you're actually able to get growth notes on equities that have the same volatility as bonds. So you're actually able to take risk in positions that have greater volatility when they appreciate and less volatility when the market sells off or goes down. So this is the type, that's the way you want to structure your volatility for specific views or specific situations. One note I'm going to highlight that we've put together for our clients, which was tremendously successful, for Japanese equities. You used the worst of format between the Nikkei and the TOPEX. Those are both indexes of the Tokyo Stock Exchange. They're calculated differently. A 5-year term, again, 30% barrier contingent protection. And we got a multiplier of 2.52 times. Why did we do this note? Well, we thought Japanese equities were undervalued. We can go back to the quote about diversification from Vanguard, and getting a multiplier is certainly, when you think something is undervalued, is great. We also had a view on the currency and on the interest rates between Japan and US, and which made the note more favorable than buying indexes on their own. Now, I mentioned before, we talked about a rainbow option. This is another note that we issued. And the reason I liked this note was because it was based on the S&P 500, the NASDAQ, and the Russell 2000 on the futures excess return index. But we're putting it in a note. So those notes could have much better terms, right? So we used a 5-year term, and I didn't use protection on this because I used a rainbow option. Now, what is a rainbow option? It's a weighted average, 50% best performer, 20% worst performer, and 30% median performer. Well, it's exceptionally better than the worst of note, right? Because this one's only getting 20% of the worst performer and 50% of the best. It also has a 1.71 multiplier. I'm replacing existing exposures that are already in my portfolio. I'm getting a weighted average of 50% of the best performer. I'm getting a multiplier of 1.71. But when we look at multipliers on these cash indexes, one that's a worst performer of those, you get a 1.6 to 1.8 multiplier. I'm getting only 20% of the worst and the same multiplier in the futures excess return for 5 years. Here's a customized solution. You bought a stock for $10,000 and it's now worth $100,000. You have a $90,000 gain. You're afraid the stock might retrace short term, but you don't really want to sell because of tax implications, right? So those tax rates I have up there, you're going to be paying about $27,000 on. You'd be left with $73,000. So you have to say, is the stock going to fall 27%? You might want to mitigate some short-term losses. You keep the stock and you buy a structured note. The time period we picked was 1 year and 1 day. All the gains are treated as long-term capital gains on the note, as opposed to be treated as income. What was going through my mind is, okay, this client has a lot of money in bonds. Let me create a note. This underlying stock goes up, is going to pay them a bond-like return because they already own the stock, and then they're going to get their bond return. The note is replacing what the bonds do. Stock is up, you get a 50% participation to a cap of 10. So your maximum gain is going to be 5%. Stock goes up, you're going to make money on the stock. Stock goes up, the note's going to pay you like a bond. Now, what happens if the stock goes down? Well, we want to have an absolute participation. Stock goes down 10%, you make 7.5%. Now, what type of protection are we going to have? With the buffer, a buffer would give us protection down to 26%, meaning that if we got down to almost 26%, 75% of that is you would be up 19.5% on the note. But if at maturity it's down more than 26%, let's say 30%, you would actually lose 4%. The barrier level is 37.5%. If you don't think the stock is going to go down that much, maybe this is the better version for you. And the max payoff would be a little bit over 28%. The stock is down at maturity. These are two excellent alternatives to selling the stock. Dark purple line of keeping the stock is in tandem with owning the note. So if the stock does crash out, well, you're in a bit of hot water where, hey, I get to keep my stock and not pay taxes. And instead of keeping money in fixed income, I buy the note, which will make money if the stock goes down initially. Buffer makes less money. The barrier can make more, but can lose more. And you're still making a 5% return if the stock goes up, which is greater than what you'd earn in the fixed income.